Hi traders, this is Jeff. Welcome to Iron Condors 201. 101 being, I guess, the first course of sorts, and 201 being the next one. Hopefully you're familiar with Iron Condors when you watch this, because I'm not going to really talk about Iron Condors. Basically, I'm going to talk about goofing around with them a little bit, I guess you might say, to just look at them differently, I think, would be a good way to put it. So I was inspired to do this video by a friend of mine that reads my blog and happens to live in Columbus, and we've actually talked on the phone a few times and met face to face, and he currently has a trade on RUT, which is the Russell 2000 cash index, that I believe he opened around the end of January, first part of February, maybe the first week of February. And let's zoom in on that on this chart here, and we'll take a look at it. Let's say that he might have put the trade on somewhere around in this area here, I would say. And what he did was he did a short strangle. Now, I have an IRA account. I can't do a short strangle. So he said, well, you might want to try doing an iron condor with very wide wings to see if you can work it out to end up with the same type of profit and loss scenario. Well, turns out you can't get exactly the same risk reward that he currently has on his, but you can get pretty close. And it was kind of interesting when I started playing around with it and changing some expiration dates and taking a look at probabilities and things like that. It ended up being possibly a trade that I may want to put on, even though he put his on way back like a month ago or so or more. You still can put this trade on, and you can even move your expiration dates up using exactly the same strikes that he used on his trade and still have it look pretty good. So let's take a look at that. We'll go to the Analyze tab, and here is Bruce's trade right here, and this is his short strangle. It's like an unbalanced strangle. Normally they would be at the same strike, and a lot of times they're at the money, but he twisted this around a little bit and turned it into a really nice looking trade. I don't know the particulars of his entry, but looking at some of the pictures that he has sent me, it looks like he probably got about a $68 credit on this, or $6,800 as shown up here. The red number over here being the at expiration price. Well, let's change our probability date here. Always remember to do that. Only if you want to look at probabilities. It doesn't really do anything to anything else. It just gives you your probabilities. I'll reset my slices, make sure everything's cool here. So now you can see that even if there's a 10% down move or a 10% up move in the market, he is still going to make a nice profit on this, and maximum profit actually is out here at, he has a 70% chance between now and September of making maximum profit on this. On this side, going by this number and going by this number, taking the worst of the two, actually 71%. So 70% chance of making maximum profit on this. And if you go out to actual break even, it's got almost about a 85% of not losing any money. So that's pretty decent, I would say. And you can see here it says in my account, which I have up here, it says it's illegal because I need to cover this with 100 shares, and I am not going to buy 100 shares of this at 805 just to cover this trade. So there's another way to do it, and that's to do an iron condor. So the way that I'm going to show this to you is let's make sure we are in September here. And I'm going to do it as two separate credit spreads so I can play around with it. It's a little bit easier to play around with it then. So if you look, he has the call at 900, so let's go ahead and sell a vertical here. at 900, and then the other one here is at 710. So we'll go to the 710 strike way down here, and we will sell a vertical there too. Now also I want you to notice on these Septembers the delta is 26. That's a pretty high delta, which means you're going to get a really nice credit when you do this trade, but you're going to be a little bit riskier. You know, iron condors and credit spreads, I usually like to hang around 10 to 15 per delta usually, although lately for weeklies I can pump that delta up and a lot of times get close to 1, but that's a whole other story. Back to this one. This is where we are. We have these two credit spreads, a call at 900 and a put at 710. Let's go to our risk profile, uncheck the short strangle, and take a look at what we have here. We can see that what the higher implied volatility of the put spreads is doing to us, and that because it's higher volatility, we're collecting more credit, so our risk isn't as great on this end as it is on the call end. But we need to make the slope a little bit not as steep. So let's see how we can do that. And the way that I had set this up was to give me like a $50 spread on this. So if my short call's at 900, I want my long call to be at 950, and my short puts at 710, so I want my long put to be at 660. Is that right? Am I doing that math right in my head? Oh yeah, I am doing that math right in my head. Well, congratulations to me. Now I'm going to lock down these prices here so they don't change while I'm explaining this or demonstrating this to you. Alright, so what we have here is a trade similar. We have $2,800 at risk. We could pump this up to put as much at risk as Bruce has on his trade, which I think is around 14,000, by just increasing the number of credit spreads that we want to do here, or number of iron condors, 14,000 roughly here, and here, well, we can make as much as $10,900 here. Well, that looks pretty attractive if you want to risk $14,000, but I'm not really into that, so I can't take that much risk. As a matter of fact, this 2,800 here is quite a bit for me in the first place. But let's compare. Now we have $2,800 in risk and a possibility of making $2,100. And if we look at maximum profit, we have a chance of 70% chance of making maximum profit between now and all the way out to September. Reset the slices. We'll look at our 10%. Even if it moves 10% in either direction, in September at expiration, we still would be at maximum profit. So this looks like a pretty good trade. What happens a month from now? And this is where the trade gets interesting, because what I have found in my playing around is that you don't plan on staying in this till September. You stay in a month or two. Risk is too great. Time is risk. So you don't want to stay in this too long. So let's look at a month from now. Well, you're up $172. Not bad. Let's look at 2 months. And that's only if price is right here, right in this maximum profit zone here. If you go out 2 months, you're seeing that you're at $595. Now, that's sort of increasing exponentially. And why is that doing that? I click on this reset parameters button here, and this brings me back to reality, which is today, and our theta on this trade, which is the amount of cash that we are credited for this trade with the deterioration of the time value on our short options is $5.74. That's what we would earn today if the price stayed right here. And if we moved up another day, it's 578. Looking at data, move up another day, it's 581. Move up another day, it's 585. Well, okay, so each day it's collecting a little bit more money provided the price stays exactly where it's at. Let's go back to looking out a month, the 11th of April, and let's play with volatility. Let's say we increase 1. Now you look right here, we're at $203, right? So let's do a plus 1% in volatility. We're down to 114. You don't really want volatility to go up. Because that is going to hurt you. And the reason why is as volatility goes up, we're at 2% now, we're back down to break even a month from now as volatility increases. And the reason why is if you wanted to close this, and that's what this white line is assuming, that you wanted to close this today, it would cost you the price of the short options would be increasing to buy back. So, and it would be at a faster rate because they're closer to in the money than the long options, or the long strikes. So that's the reason why your profit drops as the volatility increases. But conversely, if it goes minus 2%, well, we like that. So we would like volatility to drop. We would like the market to settle down and maybe move up a little bit. The VIX right now is at 20. If it went back to 18, 15, 14, whatever it was at, I'm not sure what rut volatility would be at, but I'm sure these puts would calm down a little bit with their volatility, and I think I probably could do that for each one, but I'm not gonna mess with that. But what I wanted to show you was what happens now, and we'll reset this. What happens now if we say, well, September's too long and theta's too small, and I'd rather see a little higher theta, and I could take a little bit more risk, and so let's take a look at that. Well, actually, you would actually be taking less risk because you're shortening your time frame to expiration with the same spread here, which is a really huge spread. So if we change this, let's go down here and we'll go to June. So if we go to June, I have to unlock these prices and relock them again. If we go to June now, we can see that we have $3,600 at risk, and we have $1,300 maximum profit potential on this. We have 30% probability of making maximum profit between now and June, which is 3 months away. Well, that doesn't look too bad. So what happens, so look at our theta here is 1135. That's almost double what we had theta in the September. So if we bump this out to April, and if it's falling in this range here, let's move these slices here. Let's say that we're falling in this range. We could be from 289 to 399 to 285. That's not too bad. And if we went to the month before it actually expires and took a look at it, we'd be looking really pretty good on this trade. Not bad at all. Now for probability, I need to change this back here, and I forgot to do that when I was covering that before, and I apologize for that. Let's reset the slices. So the probability of this reaching maximum profit by expiration this is just probability now, is over 90%. And I mean, you cannot, that's a pretty nice looking trade right now, don't you think? You have a 90% probability of making maximum profit on this trade. Risk 3,600 to make 1360. So let me do that here and do a calculation. That's a 37.777777% gain if you hang on to this until June expiration. That's not bad. It's not bad. How does it look if we change the month to May? And change our, let's unlock the prices and relock them again. And change our probability here to May. And now we're looking at this. Why is this doing this? This shouldn't be doing that. Okay, folks, what do I got wrong? Oh, there we go. Reset parameters. Alright, lock our prices down. There we go. Alright, now we're looking at $937 and a 16%. That's 83% chance of maximum profit. May. We are at May. Okay. I need to go back and look at that June. What happened here? Oh, I got 2 Mays here. Why are there 2 Mays listed? I don't know. June, based on June 17th. Oh no, I was wrong. I don't know what I had down there. I must have had September up there yet or something. But actually, the probability of maximum profit is 80% for the June. Sorry about that. I'm sure a lot of you are watching me doing that going, oh geez, there he goes again. He's off on a tangent. Alright, so again, our theta, let me unlock this. Again, our theta is 1144, and we have an 80% probability of maximum profit. Alright, now I know what I'm doing. Let's go to May, and we need to switch to May up here. Come on. There we go. Now that's looking, that makes more sense now, because now we're looking at a 85% or 84% probability, 83 somewhere around there, probability of maximum profit. I need to change these slices to prices here, and $937 with $4,000 at risk. Now remember, the June was 37.7%, and this one will be 937 divided by 4058. That comes out to 23%. Who would complain about that? And look at this, even with a 10% move. I'll reset the slices here. Even with a 10% move, you're still in there, looking good. Your theta is now 13, which is $2 more than it was for June. And a month from now, it'll be 484, which is a little bit better than the June. So this trade is looking kind of good, and I may just put this in my profit tent portfolio with the intent of sticking in like a month or so, depending on, this is max, right? This is right at this practically zero delta here, so you're going to be max here, and actually max is 490, 491, 490. Yeah, we try to get this delta to 0. I can't change that, unfortunately, but I can change this price to try to get a 0 delta. And there we have a 0 delta, and 491 max on April 11th is at 811.30, and if it's there, then you rake in $491 and you can close the trade and do another one in June at that time. So let's look at the chart. 811. Here's 811 right here. Let's put a price level in here at 811. So do you think that it could be close to there a month from now? It's certainly been spending a lot of time going around past it and then back down, below it, above it, below it, above it, passing through it. All you need to do is catch it when it's passing through it and get out. So I mean, that looks like a fairly decent trade. So that's it, my friends, for this particular rambling on this particular kind of trade. I thank you for watching. Please visit my blog at theoptionguru.com/blog. Throw comments out there. I always appreciate hearing from folks. So please comment on this video, comment on any of my posts. I like to hear from you. Thanks again, and have a great day.